Welcome back to Investing Talk Podcast. We're about to explore a stock that's really generated a lot of buzz, maybe for the wrong reasons, given its price movements. Today, we're tackling that critical question. Is Helius Medical Technologies a good time to buy now? Helius Medical Technologies, they're a neurotechnology company. You might know them for the Polonus device. That's the portable neuromodulation stimulator. It's designed for various neurological conditions. Pretty innovative stuff. Now, as of June 2025, the stock's been hovering around, 33 cents a share? And, a price that low, well, it makes people curious, doesn't it? Is it a bargain or a big red flag? Before we really get into the weeds here, if you find this analysis valuable, please do think about subscribing, liking, maybe leave us a comment. It genuinely helps us create more content like this. And if you feel like supporting us further, you can always buy us a coffee. So let's start peeling back the layers. What's the first impression when we look at Helius Medical Technologies, especially financially?
Yeah, what's really interesting here, maybe a bit concerning, is that Helius, even though they're in this, promising neurotech field, the financial picture is tough right from the get-go. When you look at the core numbers, they tell a very clear and frankly, quite an alarming story. It's not just shaky. It points to some deep issues.
Okay, so let's start with the basics then. The Polonus device, what is it exactly? What's it supposed to do?
Right, so the Polonus device, it's a neurotech solution. Quite innovative, actually. It delivers mild electrical stimulation to the tongue.
To the tongue.
Yeah, sounds unusual. But the idea is it engages the brain through cranial nerves, stimulates neuroplasticity, the brain's ability to reorganize itself. The goal is improving neurological function. It's got FDA clearance for treating gait deficits.
Yeah.
So issues with walking or balance in MS patients.
Okay, MS gait deficits?
And it's also authorized in Canada for some additional uses. So yes, they definitely have an approved, unique product.
An approved product is definitely a big step, suggests the science is there. But when we look past the science to the business side, the financials, sounds like that's where the problems really start. Can you walk us through revenue profitability?
Absolutely. And this is where it gets pretty stark. The financial performance is weak, and it's actually been declining.
Declining? That's not good.
No. For fiscal year 2024, revenue was just $520,000.
Okay.
That was down over 19% from the year before, which is $644,000. And then Q1 of 2025, it got worse. Revenue dropped to only $49,000.
$49,000 for the whole quarter.
For the quarter. Compare that to $135,000 in Q1 of 2024. So yeah, a significant contraction.
Wow, okay. Losing more than half your revenue quarter over quarter. That's dramatic. What about actually making money? Profitability?
Far from it. The profit margins are severely negative. The net profit margin, it's kind of staggering.
Yeah.
Negative 3,010%.
Negative 3,000%.
Yes. Basically, for every dollar of revenue, they're losing over $30.
That's hard to even comprehend.
It is. And the gross margin, just revenue minus cost of goods sold, is also negative, minus 33.64%, which suggests the product isn't even covering its direct production costs.
So they lose money just making the thing, before even considering overheads.
That seems to be the case. In Q1 2025, the net loss was $3.8 million.
And that's up from the previous year.
Up from a $2.5 million loss in Q1 2024. These aren't just losses. It's a cash burn rate that really questions their viability.
That sounds incredibly unsustainable. How does that hit their cash balance, their overall financial position? Are they running on fumes?
Well, that brings us to a really critical point. Sustainability. As of the end of March 2025, Helius had only $1.1 million in cash and equivalents.
1.1 million with losses like that.
Exactly. And they've racked up an accumulated deficit that's total losses over time of $175.5 million. They're burning cash fast. Operating cash flow was negative, $3.5 million used in just Q1 2025.
$3.5 million out the door in 3 months with only $1 million left.
You see the problem? This kind of burn with such low reserves, it absolutely raises what's called the going concern issue. Big questions about whether they can keep operating.
Going concern. We hear that term. Can you just quickly unpack what that means for a company like Helius and why it's such a serious warning for investors?
Good question. When you hear about substantial doubt about its ability to continue as a going concern, it's basically auditors or analysts saying, look, there's a real risk this company won't have enough cash to operate for the next 12 months.
So a formal warning they might not survive the year.
Pretty much. It's a critical flag. It signals a high risk of bankruptcy or needing emergency funding, often on really bad terms for existing shareholders, maybe even getting delisted. It's one of those serious warnings out there.
Okay, understood. Given that grim picture, the cash burn, the going concern warning, is there any positive on the balance sheet? What about debt?
Surprisingly, yes, there is one, a
Yeah.
sort of silver lining amidst all this. Their balance sheet is relatively clean in terms of debt, minimal debt obligations.
Yeah.
Yet the debt-to-equity ratio is effectively zero. So they aren't burdened by large interest payments or looming loan defaults.
That's something, I guess.
It is, but it doesn't solve the core problem. They're not drowning in debt, but they're still bleeding cash very, very quickly from operations.
Right. So let's zoom out a bit. The company's finances are clearly distressed, but they operate in neurotechnology. That sounds like a field with huge potential, right? Is the market itself growing?
That's the paradox here. The neurotechnology market is growing robustly, absolutely. Projections show it expanding significantly, from around $15 billion in 2024 to over $50 billion by 2034.
Wow, that's a big jump.
It is a compound annual growth rate over 13%.
Yeah.
It's a very promising sector. Brain-computer interfaces, neuromodulation like PON and S. Lots happening. The industry has momentum.
Okay, so the industry tide is rising strongly. Why isn't Helius being lifted by it? How do they actually fit in? If the market's booming, why are their revenues falling off a cliff? What's their competitive standing?
And that's the core issue, isn't it? Despite that booming market, Helius's competitive position seems weak. They have very limited market penetration. They're facing real commercialization challenges, just getting the product adopted and sold.
So approval isn't enough.
Not at all. They're up against huge established players. Think Stryker, Medtronic, Johnson & Johnson MedTech. These companies have massive sales forces, huge R&D budgets, existing relationships.
A completely different league.
Exactly. And besides the giants, there are many other specialized neurotech companies also fighting for a piece of the pie. So while PON-S has its clearances for MS-Gate in the US and other things in Canada, actual commercial adoption, it's just been very limited. They haven't cracked the code on sales.
Okay, so a tough competitive environment explains some of the revenue struggles. Now let's talk valuation. We often look at PE, PS, PB. What do those tell us here? Is that $33 share price reflecting deep value?
Well, valuation here is tricky, precisely because of the financials we just discussed. Price to earnings, or PE, doesn't apply. They have no earnings, just big losses.
Yeah.
Price to sales. Based on their tiny market cap of about $1.6 million and trailing revenue around $434,000, it's roughly 0.34x.
0.34 times sales? That sounds incredibly low.
It looks low, yes. Suggests the company's valued at less than a third of its annual sales, but it mostly just reflects how minimal their sales actually are and market's deep concerns rather than indicating it's some hidden gem.
And price to book?
That's around 0.16x. So the stock trades way below the net asset value on their books.
Again, sounds cheap.
But again, it likely signals the market's skepticism about the real value or liquidity of those assets, especially with that going concern risk hanging over them. Book value isn't always realizable value.
So these super low valuation numbers, they're not really a buy signal, more like a warning signal reflecting the underlying problems.
Precisely. Compared to industry averages for medical devices, Helius trades at massive discounts. But these discounts are almost certainly reflecting those severe fundamental challenges. The losses, the cash burn, the lack of revenue, not some overlooked opportunity. A cheap stock can always get cheaper if the business itself is broken.
Makes sense. Let's shift to the technicals then. What does the stock chart itself look like? How has the price actually been behaving?
In a word, catastrophically.
Yeah.
The price performance shows just a complete lack of investor confidence. The stock is down something like 96.7% year to date,
Wow, almost wiped out this year alone.
and down 97.8% over the past year. It's trading right near its 52-week low of 30 cents, currently at 33 cents, and all the major moving averages, the 5-day, 10, 20, 50, 100, 200-day, they're all pointing sharply down. The stock is way below all of them.
So a confirmed downtrend on all time frames.
Absolutely. A clear, sustained, deeply bearish trend.
Okay, a very bleak technical picture confirming the fundamentals. What about momentum indicators? RSI, MAC? Any sign of selling exhaustion, maybe a potential bounce?
Well, the momentum indicators basically echo that bearishness. The relative strength index, RSI, is around 33.
So near oversold territory.
Close to it, yeah. Below 30 is typically considered oversold. But being near oversold, especially in a stock with these kinds of fundamental issues, isn't a reliable buy signal on its own. It can stay oversold or just bounce weakly.
Right.
The MACD indicator is a negative at minus 0.073, showing continued negative momentum. The downtrend is accelerating. And Williams-Broussard is way down near 97, confirmed as severely oversold conditions. Extreme selling pressure.
So no relief visible there.
Not really. Multiple technical analysis platforms consistently rate Helius as a strong sell,
based on these indicators.
And volatility. I imagine a stock like this swings wildly.
Oh, extremely volatile. You're right. The average weekly price movement is over 28%,
28% a week.
compared to less than 9% for the medical equipment industry overall. This kind of extreme volatility makes it incredibly risky, even for short-term traders. Hard to predict, easy to lose capital fast. It's more gambling than investing.
Okay, so fundamentally challenged, technically broken. Have there been any recent developments, any news that might offer a glimmer of hope or change this trajectory?
There have been a few things, yeah. They illustrate the company's, sort of, fight for survival. Back in May 2025, they did a 1-for-15 reverse stock split.
Okay, consolidating shares to boost the price.
Exactly. Primarily to get back above the Nasdaq minimum bid price requirement and avoid delisting. They did manage to regain compliance, which buys them some time.
Get something. Anything else?
They've also secured authorizations from 5 major healthcare payers, Cigna, Anthem, Aetna included.
Ah, for reimbursement.
Yes, for PONS device reimbursement, at prices between about $18,350 and $19,160.
That sounds positive. Getting insurance coverage is key for sales, right?
Yeah, it's definitely a necessary step, yes. It removes the barrier for patients, but it's only one piece. You still need doctors prescribing it and patients wanting it.
And what about cash? Did they raise any money to deal with that burn rate?
They did. In June 2025, they completed a public offering, raising $9.1 million.
Okay, $9 million buys them some more time.
It provides temporary relief, yes. But it came at the cost of further dilution for existing shareholders.
Right, selling more shares means everyone's slice of the pie gets smaller.
Exactly. It puts downward pressure on the stock price, even as it brings in cash. A necessary evil, perhaps, but painful for current investors.
That makes sense. What are analysts saying? Is anyone covering this stock? And are insiders, like management, buying shares?
Analyst coverage is pretty thin. That itself isn't a great sign. The ratings that are out there seem mixed. One analyst has a hold. Some platforms might show a strong buy, but you have to be careful there. It might be based on just 1 or 2 analysts, very limited data.
So, not a strong consensus. What about insiders?
The CEO, Dane Andreev, did buy shares back in late 2023.
Okay, that can be a positive sign sometimes.
It can be. But in this case, given the stock's performance since then, those purchases resulted in significant losses for him. So even the CEO's bet hasn't worked out so far.
Right. Are there any potential catalysts coming up? Anything investors should watch for that could genuinely move the needle?
There are a few things on the horizon, but they all come with uncertainty. The next quarterly earnings report, probably around mid-August. People will watch revenue and losses, but expectations should be managed.
Very low, right?
Likely. Then there's an expected FDA submission in the first half of 2025 for using PONS to treat stroke patients.
Okay, a new indication. That could be big if approved.
Potentially, yes. It would expand their market significantly beyond MS gate. But FDA approval is never guaranteed. We're also waiting for the final CMS Medicare and Medicaid pricing decision for PONS.
Crucial for reimbursement in the U.S.
Very crucial. But the preliminary signs on pricing weren't great,
Yeah.
potentially disappointing. So that could limit the upside even if coverage is granted.
Okay, and longer term. Any other potential game changers down the road?
Longer term. Well, getting approval for even more neurological conditions would obviously help expand the market further. They're also looking for strategic partnerships, especially for Australia. That could bring in non-dilutive cash and distribution help.
Partnerships could be key.
It could be. And they have a subsidiary, Revelation Neuro, working on brain-computer interface tech. That's cutting edge. But also very early stage, likely years away from contributing meaningfully, if ever.
So, some long shots, but nothing concrete in the near term seems likely to transform the business overnight.
That seems fair to say. The immediate challenges are immense.
Okay, putting it all together then, the product, the market, the awful financials, the competition, the risks. What are the absolute main risks investors need to focus on here?
It really comes down to a few critical things. First, the going concern risk is paramount. Can they even survive? The high cash burn and low resources make it a very real question.
Survival risk number one.
Number one. Second, despite regaining compliance, the risk of future Nasdaq delisting is still there if the price collapses again. Third, the lack of commercial success. Slow PONS adoption, minimal revenue. It raises fundamental questions about whether this product is commercially viable, even if it works scientifically.
Product market fit issues?
Possibly. Fourth, reimbursement challenges, especially if CMS pricing disappoints. That hits long-term revenue. Fifth, intense competition from much bigger players. Sixth, regulatory risk future FDA decisions aren't guaranteed. And finally, the constant risk of dilution. They'll likely need more cash, which probably means selling more stock, hurting current shareholders. These are not small risks, they're existential.
Okay, so after that comprehensive analysis, let's return to the original question for our listener. Is Helius Medical Technologies a good time to buy now? What's the bottom line?
Based on everything we've discussed, Helius Medical Technologies gets a very low rating from us, a 2 out of 10.
2 out of 10. Pretty definitive.
It reflects the severe fundamental weaknesses, the huge losses, the falling revenue, the major going concern issues, the terrible technical picture. Yes, the neurotech market is promising, but Helius's execution problems and financial distress create extremely high investment risk, arguably prohibitive risk right now.
So for someone considering this stock, what's the practical takeaway? What should they do?
Practically speaking, it means we can't recommend any specific entry price. The data strongly suggests investors should just stay away for now. Wait for clear, undeniable, sustained evidence of a business turnaround, not just a temporary fix like a reverse split, before even thinking about investing.
Not suitable for traders or long-term holders.
Not really. Short-term traders face insane volatility and unpredictable moves. Long-term investors face that going concern risk and the real possibility of losing everything. If someone were to invest, it should only be viewed as a tiny, purely speculative bet, money they can absolutely afford to lose completely.
Yep.
But the overwhelming message from the data is, avoid this stock until there's clear proof of sustainable improvement and financial stability.
That's a very clear, if sobering, conclusion. And for you, the listener, maybe reflect on this. What does going concern really mean for your investment? And how a company can have an innovative product in a hot market, yet still struggle so profoundly? What specific signs of life, beyond just headlines, would truly convince you a company like this has turned the corner? That's a crucial question to ask yourself before chasing these low-priced stocks. Thank you for joining us on this exploration of Helius Medical Technologies. We hope it's provided a clearer, more informed view on navigating market complexities and evaluating companies facing serious challenges.